financial volatility. And I think in the long run, the dollar will obviously be weak. But don't forget, the other governments around the world, they embarked on similar policies. So the dollar may not collapse necessarily against the euro, although I think that it will have a weakening tendency in the long run against the euro because Europeans are more disciplined. But in general, I think that people will increasingly own some gold because they will perceive gold to be an alternate currency. They will not perceive it to be a commodity because they will say, okay, as cash, $1 million, it doesn't pay any interest. I can buy gold. It doesn't pay any interest. But I mean, at least the gold will not be multiplied to the same extent that Mr. Bernanke will monetize U.S. debt.
Clearly, unless somehow the Federal Reserve Chairman goes into the mining business, I guess we can preclude that, at least for now, right, Mark?
Yeah, sure. What can happen, of course, in the end, that in the end game, when everything breaks down, countries then usually go to war to distract the attention of their own shortcomings, and eventually they'll take the gold away from people.
Is this a trend that you see accelerating if indeed we see another financial crisis?
Well, I think that a lot of people are looking at gold. A lot of people, obviously, they bought gold and they sold it, and they find the price to be high. But I don't find the price to be particularly high compared to, say, the S&P 500 or the Dow Jones. The stock market is still basically inflated. I'm not saying that it can't go up more, but it's not the bargain of the century by any valuation standard, neither dividends nor book value and so forth. There, I would say that the Asian stock markets have probably made a secular low in March in nominal terms and in real terms, and are a better bargain.
In fact, Marc Faber, you say the risks of buying stocks right now are beginning to outweigh the potential near-term rewards, correct?
Well, I think that near term the market may still go up, say, another 10% or so, but the gravy is out. We had a rally of 50% from the March lows. You're not going to see another 50% right away. That I don't think so. But can we see another 10% and then the correction, or can we see the correction right now? Yeah, we have a lot of volatility, and when you have intervention in the marketplace, it's very difficult to make any forecast. But one thing I'm convinced, the S&P has gone from 666 to, say, now 1,030. If the S&P travels back to around 900 or below 900 towards 800, the voices of the Krugmans of this world, of the Bernankes of this world, of the Tim Geithners and Larry Summers of this world, the academics, they will all say more stimulus and more money printing. And so there is now, because of this money printing attitude, kind of a downside limit to stocks. So if the market were to weaken, I would probably buy some more stocks. Because the one thing you don't want to own are U.S. government bonds. You don't want to own any cash. Because if the dollar weakens, and you can follow that every day in the marketplace, the stock market is strong in reaction to a weak dollar. And when the dollar strengthens, it shows immediately up in the stock market coming down a bit. And this relationship, I think, will continue.
Connect that with what's going on in the world of commodities, because you say the relationship of strong equities and commodities equals U.S. dollar, weak equities and commodities, strong dollar. That still seems to exist, right?
Yes. I mean, basically, if you look at the performance of oil, it went to $147 in the summer of 2008, in precisely July 2008, in other words, 13 months ago, and then it dropped to $32 at the end of 2008, and now it's over $70. So it's up more than 100%, as well as copper and nickel and other commodities. They have actually gone up more than equities by and large. And I think this pattern will continue. You print money, people will go into commodities, because commodity supplies cannot be increased at the same rate as the printing press increases the supply of money and credit.
What's the biggest danger right around now? Is it about a second stimulus? Is that danger?
Well, I think the biggest danger is that this crisis has been avoided by postponing it. But nothing has been solved. It's been made worse.
All right.
The big crisis will come in 5 to 10 years when the whole system breaks down and the governments go bankrupt.
All right. We're going to end it on that note. I want to thank you very much, Marc Faber, the editor of the Gloom, Boom, and Doom Report.
There's more television and radio news at Bloomberg.com. Stream it live. Download it to your iPod or desktop. Copyright Bloomberg LP 2000.